Britain's finances are in a mess. Does Rachel Reeves know what she is doing? But now is your chance to make Britain great again, or at least mediocre again. I will give you 20 different options to fix a budget black hole. Do we tax the rich, cut welfare spending, or just print loads of money? This is your chance to find out what options we have. Well, firstly, we could increase the basic rate of income tax from 20% to 21%. This raises £8.4 billion. The pros are that it's relatively progressive, it's quite a big chunk of money. Also, it is broader based than national insurance. It's not just workers, but private pensions above a certain level, investors, landlords, and anyone receiving taxable income above a certain threshold. The cons are, of course, it would break manifesto promise and be a big hit to disposable income. Secondly, what about increasing the higher rate of income tax from 40% to 50%? This would raise £10.8 billion. It's very progressive, it raises quite a bit, and will place UK tax rates closer to those in Europe. The cons are that the top 1% of income tax payers already pay 30% of UK income tax, up from 12% in the late 70s. It is argued that highly mobile bankers may seek to work abroad. Also, the marginal tax rates for some groups of people is really quite high. Also, taxing income will miss those who have high wealth but low income. Thirdly, what about increasing VAT from 20% to 21%? This would raise an extra £10 billion. The pros are that it doesn't reduce incentives to work or invest. European rates are often closer to 25%. The cons are that VAT is mildly regressive, as the poor have to spend usually a higher share of their income, whereas the richer spend a smaller share. It would also lead to a one-off increase in prices and push up inflation, which would be particularly unwelcome at the moment. Now, alternatives could include a broader definition of VAT. For example, this luxury children's coat attracts no VAT. Now, a fourth option would be to increase the rate of national insurance on workers from 8% to 10%. This raises nearly £12 billion. The pros are it's quite a lot of money, a degree of progressivity, but the cons are that labour costs have already been rising a lot, the increase in minimum wage and employers' national insurance contributions, and this could lead to even more job losses even as unemployment starts to rise, so not really a good idea at all. Fifthly, what about taxing dividends at the same rate as earnings? This could raise £5 billion. The pros are that it would discourage people from setting up companies just to avoid high rates of income tax. It would simplify the tax system. It's more progressive. The only cons are that firms could have less profit to invest in research and development. Sixth, what about increasing stamp duty from 5% to 7%? This would raise just £1.2 billion. You could argue people who buy houses tend to be wealthier, but there's a big downside to this. Stamp duty makes it harder to move, slowing down the housing market, leading to inefficient use of housing, and making it more expensive to get on the property ladder, already very high stamp duty. And generally, economists say this is one of the worst taxes, and it would be best for the economy and the housing market to abolish completely. Perhaps replacing with a land value tax. Now, generally speaking, economists want to cut corporation tax and increase tax on consumption because of lower distortion and disincentives to invest. Another option is to increase inheritance tax from 40% to 45%. This gains £1.6 billion. The advantages are it doesn't affect the incentive to work or invest, but the cons are that it's a relatively small amount, bound to be incredibly unpopular. Maybe better to target loopholes and lifetime gifts. Another option is a mansion tax, 1% a year on homes worth more than £2 million. This could raise £1.3 billion. The pros are it's approximate to a wealth tax, given that housing is such a big form of wealth in the UK. But the downside is it will disrupt the housing market, with people wanting to move to cheaper homes, pushing up the price of many other houses. It's also be expensive to administer. Now, another option would be to increase corporation tax from 25% to 27%. This would raise £8.4 billion. Now, the pros are that it avoids taxing working people, though firms may seek to cut costs by reducing wages to pay the tax. Also, you could argue that the UK has one of the highest rates of tax in the world, and it may encourage multinationals to avoid investing and basing themselves in the UK. Also, it would give firms less money to invest, and investment is a big problem for the UK, which is currently very low. What about a wealth tax of 1% on wealth above £10 million? In theory, this could raise £11.9 billion. Now, the pros are that it broadens tax from just taxing work to taxing wealth and assets. Certainly, it is the most popular form of tax, perhaps because most people would not pay it. The downside, though, is that it might take several years to set up. It will be difficult to administer and evaluate levels of wealth. Some people may lack cash flow to pay. Now, the degree to which people would leave a country to avoid a wealth tax is much disputed, but at least some immigration could eat into revenue. Another option would be to revalue council tax bands to be more based on modern house prices and extend the range of bands to reflect that house prices have increased enormously since the 1990s. This, in theory, could raise between £6 and £10 billion, depending on the levels you set. The pros are it would make it much more progressive. The current council tax is really quite regressive. But the downside is that it would be a huge jump in valuations, which would particularly affect London and the South East, where the cost of housing and living is already very high. It would be political dynamite. Money would also go to local councils rather than central government, though you could argue it's a solution to be able to fund social care. Now, another option, which is perhaps quite likely, would be to increase fuel duty. If you increased it by 10p a litre, it would raise £4.5 billion a year. The pros are it takes into account some of the externalities of driving, pollution, congestion, and driving has become relatively cheaper, at least compared to public transport. And even the RAC say that the recent 5p cut was mostly held on to by retailers and not passed on to consumers, so kind of a wasted tax cut. But the downside is it has a bigger effect for those living in rural areas where there's less public transport. But given the freeze for so many years, it does become a strong candidate. And in fact, there's a candidate for a new tax, a new pay-per-mile tax for electric cars, electronic road pricing. And given the fact that there is a switch to electric cars, this is almost certainly going to come in at some time. The question is when. And you could argue it's justified on the grounds of fairness. Buyers of electric cars tend to be wealthier, but pay much less tax than petrol car owners. And petrol tax is going to disappear over the next few decades, so we'll need to introduce this at some stage if we're going to invest more in the roads and fix all those potholes. But the cons are it may slow down the switch to electric cars. Now, what about smaller taxes? How much revenue would you get from that? If you increase remote gambling duties from 21% to 50% for online casinos, that's an extra £1.1 billion. Increase general betting duty from 15% to 25%, that's an extra £450 million. Pros are relatively popular, possibly reduce gambling. The cons are a risk of a black market and doesn't really tackle the problem of problem gambling. Increasing alcohol duties by 10% could raise £1.3 billion. Higher tax may reduce consumption and problems associated with drinking. But tax is already pretty high, and many of the local pubs are struggling with falling demand and greater competition. A tax rise could push it over the edge. Finally, what about taxing the banks, one of the most profitable areas of the UK economy? The New Economic Foundation claimed that forcing banks to hold reserves which pay no interest could save £55 billion over the next 5 years. Now, if none of these tax rises attracts you, what about cutting spending? Well, firstly, let's see the bigger picture of overall government spending. The big bill is benefits, pensions and social services. Of this, the state pension is £141 billion and social security working age benefits £117 billion. There are two big growth areas of public spending: pensions and health-related benefits. Even minor changes to these will affect long-term spending. Now, in the short term, cutting the state pension by £20 a week would save £7.8 billion. Now, of course, this is not going to happen. But ending the triple lock, moving to, say, a CPI-only uprating of pensions, could save £5 to £8 billion a year. A double lock, inflation or earnings, whichever is higher, would save a smaller amount, but in the long term, could save a lot of money compared to the triple lock. Another alternative is to raise the state pension age even faster. Accelerating the age to 68 could save 10 billion a year annually by the early 2030s. But on the downside, it's already quite high. It's already been increased. And raising the retirement age has also been a factor behind the big rise in working age benefits for people who have to work longer but may have poor health to be able to do it. Another popular target, Department of Work and Pensions, state that 9.7 billion was lost to error or fraud, of which 1 billion was reclaimed, leading to a net loss of 8.6 billion, or 3% of the budget. Now, if the government fancied a U-turn of a U-turn, you could tighten eligibility for winter fuel payments for pensioners. That would save you 0.45 billion, and I'm sure it would definitely be worth the political flack that you would get. Now, one target for saving money in the 2010s was freezing public sector pay. Increasing pay 1 percentage point below inflation for 1 year could save £3 billion. But arguably public sector pay has already been falling behind the private sector, and many doctors and nurses and teachers feeling that actually they need above inflation pay rises to catch up. Now, the biggest department of government spending is healthcare. It's an area where, no matter how much spending increases, there always seems to be a shortfall. Of course, there are potential cost savings, such as relying less on expensive agency staff. Centralising NHS purchasing and admin could save 1 to 2 billion a year. Now, just out of interest, spending which gets a lot of political interest in the UK. In 2024, the UK spent a provisional 2.8 billion on the costs of hosting refugees and asylum seekers, down from 4.2 billion in 2023. For 2024-25, the published budget commitment for Ukraine is 3 billion, so still quite a small percentage of overall government spending. Anyway, if you're not convinced by all these tax rises or spending cuts, what else could you do? Well, firstly, of course, you could just increase borrowing, abolish fiscal targets, and hope the economy grows sufficiently fast to improve tax revenues in the future. However, it is worth bearing in mind the third largest area of government spending is now debt interest payments. Higher debt, especially if it pushes up bond yields, would increase this spending too. Now, what about the nuclear option of just getting the Bank of England to create money and use it to buy government bonds, financing all the spending that you want? Problem is, with inflation already above target, increasing the money supply could further increase inflation as well as reducing confidence in government fiscal policy. So there are no easy choices. And some economists say that the budget should be much more than just about raising taxes and tweaking this and that, but actually trying to change the overall tax system to reduce distortions, increase incentives, and avoid the bloat of a tax code, and try to simplify the tax system to make it easier to collect and less disincentives to, say, work harder. So what do you think? Have I missed a really good idea? Well, do let me know in the comments, and do also check out this video on the UK's post-war economic story, which is really quite interesting. A few missed opportunities. Some things are better, but could do better. It's a fair enough overall assessment. Anyway, thanks for watching. Do subscribe. See you soon.